Most people who start investing in ETFs make one mistake in the first 10 minutes of research. It doesn't feel like a mistake, it looks like a perfectly reasonable choice. But over 30 years, it cost them $40,000. Not from bad luck, not from a market crash, just from ignoring one number. I'm going to show you exactly what that number is. And then I'll give you a 4-question framework you can use before buying any ETF, so you never make that mistake. This is the video I wish someone had shown me before I bought my first ETF. Welcome back to Capital OS. I'm Paul Raduz. Last week, I showed you what happened when I invested $10,000 in ETFs for 12 months. The crash, the recovery, and the $1,626 profit. This week, how do you actually choose which ETFs to buy in the first place? If you haven't seen episode 1, I'll link it below, but this video works on its own. Let's get into it. Before the framework, one sentence on what an ETF actually is. An ETF is a basket, a single purchase that gives you exposure to dozens, hundreds, or even thousands of companies at once. When I bought VOO last year, I didn't buy Apple stock. I didn't buy Microsoft stock. I bought one thing and instantly owned a tiny piece of 500 of the biggest companies in America. That's it. That's the whole concept. Now, not all baskets are equal, and choosing the wrong one is where most beginners lose money before the market even moves. Here are the 4 questions that separate a good ETF choice from a bad one. Question number 1. What does this ETF cost me every year? This is the expense ratio, and it is the single most important number you will ever look at before buying an ETF. Here's why. Take $10,000. Invest it for 30 years. Assume a 10% average annual return, roughly the historical S&P 500 average. In an ETF that charges 0.03% per year, like VOO, your $10,000 grows to approximately $174,491. In an actively managed fund charging 1% per year, completely normal for many funds your bank will recommend, that same $10,000 grows to $134,096. The difference? $40,395. That's not a typo. $40,000 gone. Not from a crash, not from bad luck, from one small number you probably never looked at. Here's what makes it worse. You never see this fee leave your account. It's deducted daily, a tiny sliver from the fund's value, so your balance just looks slightly lower than it should be. Invisible, relentless. The rule is simple. For broad market ETFs, anything tracking the S&P 500, total stock market, or dividends, you should pay under 0.10%. There is no reason to pay more. VOO, 0.03%. VTI, 0.03%. SCHD, 0.06%. These are the benchmarks. Everything else needs to justify its cost. Now, expense ratio is the most important question. But the second one is what most beginners get completely backwards. Question number 2. How many companies am I actually buying? This is diversification. And more is not always better, but less is almost always riskier. Let me show you the spectrum. QQQ tracks the NASDAQ 100. That's 100 companies heavily weighted toward technology. Apple, Microsoft, Nvidia, Amazon, Meta. If tech does well, QQQ does very well. If tech struggles, like in 2022, when QQQ dropped 33%, you feel every bit of it. VOO tracks the S&P 500. That's 500 companies across every major sector. More balanced. When tech drops, healthcare and energy can offset some of the damage. This is why VOO dropped 25% in 2022. Painful, but 8 percentage points less than QQQ. VTI tracks the entire US stock market. That's 3,700 companies, including small and mid-sized businesses that don't make it into the S&P 500. Maximum diversification within the US market. So how do you choose? Ask yourself this: am I comfortable with higher volatility in exchange for potentially higher returns? If yes, QQQ or a growth-heavy ETF might fit your risk profile. If you want steady, reliable growth without extreme swings, VOO or VTI is your answer. Neither is wrong, but you need to know which one you're buying before you buy it. Question number 3. How big is this fund? AUM, Assets Under Management, tells you how much money other investors have put into this ETF. VOO, approximately $870 billion. VTI, $586 billion. QQQ, $375 billion. SCHD, $84 billion. Why does this matter? 2 reasons. First, stability. A fund with $870 billion doesn't close tomorrow. A fund with $5 million might. If a small ETF gets shut down, you're forced to sell, potentially at the wrong time and with tax consequences you didn't plan for. Second, liquidity. Bigger funds are easier to buy and sell without moving the price against you. The minimum I'd look for: $1 billion in AUM. Below that, you're taking on extra risk that has nothing to do with the market. Every ETF I mentioned today, VOO, VTI, QQQ, SCHD, clears that bar by a significant margin. 3 questions down. The 4th one is the one that most people skip, and it's the one that determines whether your ETF actually pays you while you hold it. Question number 4. Does this ETF pay me dividends, and how much? If you watched episode 1, you know this already. SCHD paid me $27 in April 2025, right in the middle of the crash. The price was down, the income kept coming. That's the power of dividend yield. Here's how the ETFs we've discussed compare. SCHD, approximately 3.3% dividend yield per year. On $3,000 invested, that's roughly $99 per year, paid quarterly in cash. VOO, approximately 1.1% yield. On $7,000, that's about $77 per year. VTI, approximately 1.1% yield. QQQ, approximately 0.5% yield, because tech companies typically reinvest profits instead of paying dividends. Now, higher yield is not automatically better. SCHD's 3.3% comes with lower price growth than VOO. QQQ's 0.46% comes with the highest growth potential. The question is, what do you want your ETF to do for you? If you want income, cash in your account every quarter, lean toward SCHD or similar dividend ETFs. If you want maximum long-term growth and can wait, VOO or VTI. If you want aggressive growth and accept higher volatility, QQQ. Most beginners benefit from combining at least 2 of these, which is exactly what I did in episode 1. So here's your framework. Before you buy any ETF, run it through these 4 questions. Question 1. What's the expense ratio? If it's above 0.10% for a broad market ETF, look for an alternative. You should never pay more than necessary for a fund tracking a standard index. Question 2. How many holdings does it have? Understand what you're buying. 100 companies means concentrated exposure. 3,700 means maximum diversification. Neither is wrong, but it must match your goals and your risk tolerance. Question 3. What's the AUM? Minimum $1 billion. No exceptions for a beginner portfolio. You don't need the extra risk of a small fund. Question 4. What's the dividend yield, and does it match what I want from this investment? Growth or income? You need to decide before you invest, not after. Run any ETF through these 4 questions and you'll eliminate 90% of bad choices before the market even has a chance to affect you. These 4 alone are enough to build a solid beginner portfolio. In a future video, the advanced version, I'll show you 3 more criteria that take you from a good portfolio to an exceptional one. Let me leave you with this. The difference between a beginner who builds wealth and one who doesn't is almost never intelligence. It's almost never timing. It's almost never luck. It's whether they asked the right questions before they made their first move. Now you have those questions. If this was useful, subscribe. Every week I put out a new system: investing, AI tools, passive income. No filler, no hype, just frameworks that work. And drop a comment below with the ETF you're considering or the one you already own. Tell me which of these 4 questions surprised you most. I read every single comment. Everything in this video is my personal opinion and for educational purposes only, not financial advice. Always do your own research before making any investment decision. I'm Paul Radutz. This is Capital OS. Build smarter.